Nice to be back too.
It is September 2023. I must say, this year for me has just gone so quickly. It is. I know I say it every year, and it's such a standard thing to say, but how are we in September?
Well, it's nice to see the back of winter. Anyhow. So that's a good start.
Yeah, very positive. Just off air, Shane, we were chatting a little bit about our sporting level of sporting commitments coming up. So with the dry weather, I think I'll be playing a little bit of cricket and coaching again. What about you, mate?
Well, I'll stick to the golf course, I think.
The golf?
I'll stick out there on the golf course. I feel might be better than my cricketing ambitions.
How are you hitting them these days?
Frequently.
Very good, very good. All right, shall we make a start? So I guess what we're keen to chat about today is a number of different themes. But firstly, Shane, I know you identified over the course of the last probably 3.5 years, it's been a really tumultuous period of economics, I suppose. And so we've put a little slide together which outlines what we've actually dealt with from an economic perspective since March 2020.
Yeah, it's interesting, and look, we'll sort of touch on a couple of these points in a moment, but sometimes when you're kind of living in the moment of what's happening around us, you kind of forget all the things that we've lived through. When you try and put that into context about now versus history, these things here, pandemic over the last, largest pandemic, over $4 trillion of printed stimulus, interest rates lowered to zero. Now, obviously, we're seeing the reverse of that, kick up, inflation at its highest level in 40 years, closest we've been to World War III, oil prices, crypto bear market, even crypto didn't exist several years ago. Now it's a theme that we talk about, credit card debt, so housing affordability. We're seeing some, things that don't typically happen all that frequently. The bank collapse in the US in recent times, bond volatility, we've had the worst bond conditions that we've seen on record for over 100 years.
Yep.
So, and I guess the reason to maybe talk about this is just to reflect on it and think it's okay to kind of feel like not okay sometimes about what's happening in the world, because this has been a pretty crazy 3 years of time, and and I think it's important that we always think about those factors when we contemplating portfolios, returns, how the markets are reacted to these events, and kind of try and put all that into context about how we make decisions as investors and how we handle our capital moving forward. But lots to digest in there, but interesting just to reflect on.
I think, COVID was clearly historic, and it was the, as we said, largest pandemic in 100 years, and it had a very significant impact with how we lived our lives, and for a period of a couple of years. And it was a good couple of years, right? So it went on for a while, and there was severe health impacts for a lot of people, and we lost loved ones, and it was severe. But then I think also what's then happened is the economics of COVID, which is I guess where we can chat more deeply about, that's been significant as well, which I guess is what this chart reflects, right? So, interest rates to zero.
Yeah.
I mean,
it's crazy, right?
Yeah.
And then, the reversal of that, quite quickly.
That's right.
We'll see some charts later in this presentation about that whipsawing of interest rates. And I've always thought in the back of my mind that it's probably a 5-year journey, COVID, in a way. The health issues you described before, 2 to 2.5 years or thereabouts, and then we're now still living with every single day the economic aspect of that, and how long that goes for. It's still yet to be determined, right? But it feels like it's going to be a little while until it's fully washed itself through.
Yeah. And then, of course, with the levels of inflation that got to almost in some instances record levels. It's just been a very tumultuous time, I guess, is probably the best way to explain it over the course of the last few years. But but I guess also too, it's what we're trying to do right now is just recognise this. But equity markets and financial markets tend to look forward as opposed to look back, don't they? So,
and it's I sort of smile in a way because we're so desensitised to things nowadays. I think, which is to case in point here. The bottom left there, closest we've been to World War III. It's probably a big statement, but we've had a country invaded by Russia, and that in itself is inflationary. Putting aside the humanitarian component of that, which is catastrophic, but the inflationary aspect of that is purely adding fuel to the fire in what was already a big fight with the the pandemic washout. So
yeah, that's right.
We'll explore some further as we go through. But I think just a nice point just to reflect on and
just to start
and
with.
just look at all the things that we've been dealing with from an investment perspective.
Agreed. Yeah. All right. So let's roll into what we typically work through. We're actually waiting for some updated economic data here, but and again, we talked about this last time, but essentially what we're looking at here is we're seeing during COVID a massive reduction in GDP growth all around the world, and then a real spike once interest rates went to zero. And then to stop that level of inflation, what we've seen is interest rates spike upwards again. And so we've started to see economic growth fall back. And as it's fallen back, it's falling back to around the world to be around about 2.7 at the moment. Which is still a reasonable number. That's, as we chatted about last time, it's still a reasonable number. It's okay, but what plays out over the course, which is what we'll talk about in a minute, but what plays out over the course of the next 6, 12 months, 18 months will be fascinating.
And that trend that we're seeing there, that's going down. But before we move to Australia, I think also it's important just to contemplate this chart in the context of what we just talked about as well, because what stands out to me here is the level of central bank influence on these numbers.
Yeah, that's true. Yeah.
So we've had a health crisis. The central banks have come to the aid with respect to stimulus, or as we saw, governments kind of locking people in their homes for an extended period of time, which results in those declines here. But those sort of anomalies, and I think in time this is going to stand out even more and more as we see normalised numbers over the next 5-10 years. This spike that central banks have contributed to is significant in the context of history. Yeah,
absolutely correct. In terms of the Australian numbers, the Aussie numbers, I guess again what we're seeing, and we're actually recording this at about 10 o'clock on the morning where the latest quarterly numbers for GDP growth are going to be released at 11:30 today, so we're running a bit early. But I guess what we're expecting to see with those numbers is a shallowing again. And so last quarter we saw 0.2. Quarter before that we saw 0.6. Back in pandemic times we saw a significant reduction and then a spike. So it'd be interesting to see what comes out at 11:30 from last quarters.
Yeah, and just to again remind people, a lot of people are aware of what a recession is technically, but we need 2 quarters of negative growth.
That's right.
In this chart to be technically in a recession. So, the last quarter at 0.2 is pretty close to zero in my math. So, we're teetering on the edges of it, and maybe just maybe might escape it.
Maybe, yeah, we'll see. But I guess the thing to say here is it's not. In a perfect world, I'm sure the RBA and the government would not want to cause a recession.
Agreed.
They wouldn't, because it's not good optics for a start. But the reality is, with increasing interest rates by what is essentially 350% over a very short period of time, things are going to slow down.
There's a consequence to that, right?
That's right.
And it hasn't. I was just reading Governor Lowe's speech yesterday.
Yep.
And again, he noted it takes a good 12 to 18 months for the impact of a singular rate rise to wash itself through. So if you kind of think about that in the context of 14 months of rate rises, we're really only just going to start to see now the impact of the first rate rises now, and then fast forward 12 months, it's continued to rise and rise and rise. So we'll see these numbers don't lie, right? So it'll be interesting to see how they do play out. But again, important, GDP growth doesn't always speak to how share markets behave, right?
No.
It's and we've seen so many people ask questions in recent times along the lines of, I just don't understand why share markets have been buoyant, and yet I hear on the news we're going to have a recession.
Yeah.
And there is a genuine disconnect between those two metrics.
That's right. Or lag.
Yeah, lag.
Yeah. All right. Moving on. So here we've got some CPI inflation numbers across both the US and Australia. So on the right-hand side, over here, we see the Australian numbers, the monthly CPI numbers. And I guess probably what we want to point out here is inflation got as high as 8.4, which was coming into the end of last year, last calendar year. But again, what we've sort of seen since then is a reduction in the levels of inflation, particularly in Australia. So these are the CPI numbers, and now sitting at around about 4.9. So the RBA's band is typically known as being between 2 and 3%, and there's a whole bunch of different factors that they look at for that to ensure that it gets in between 2 and 3%. But we're on our trajectory down, which is a direct result of increasing interest rates for both businesses and also consumers.
Yeah, and there's maybe some telling stats there when you look at the US as well, right? Australia's certainly been lagging the world when it came to the commencement of the pandemic. As when the virus arrived, and then the response, and then economically the response has been a little bit slower. So you see those green highlighted areas there. We're probably 6 months behind the US where we peaked.
Yep.
And if you then fast forward, you take out the last 6 months, it's a similar trajectory of what Australia's going on. But you see the US numbers now, getting closer to that band you just talked about, Cam. So perhaps that might be what we see in the next 3 or 4 months, is getting closer to that.
I think
that
that's
band.
Yeah, that's certainly expectation. I know the last print, the monthly print was 0.18, wasn't it, in Australia? So if you want to annualise that number forward, that gets, if it's 2, that's about 2.5. Yeah, that's of course not. We can't do that, but it's just interesting with the monthly numbers coming through now are starting to be a lot lower than what they have been in the past. And then certainly in the US is currently sitting at about 3.2. Okay, so again, their band's between 2 and 3, so that's pretty close. It's pretty close to their band. So they're getting to a point where we might start seeing some, dare I say it, rate pauses, or even reductions.
Yeah, and it's this. I think this is the kind of where the markets are bouncing around and oscillating on any given day. Is how restrictive and for how long do we need to see the interest rate environment be? And there's no answer to that at this point. So more and more, the more data that comes out, we'd expect to see more people have more informed decisions they can make. But it's still a bit of an unknown, isn't it?
It is. Okay. Wages and unemployment. Just wanted to do a quick comparison here of April 23 data versus August 23 data, and essentially what we can see is this wage price index growth line has continued its trajectory upwards, which is what we're seeing here. Which I guess also is not a surprise given the very low levels of unemployment that we have in Australia. This is specific to Australia, this data. Low levels of unemployment that we have in Australia, and then similarly a really high, or almost the highest level of participation rate that we've ever had. So there's what comes next. When there's a scarcity of something, economics tells us that prices start to go up.
And I think this speaks a little bit to the inflation slide on the previous chart as well, because the one kind of factor that the Reserve Bank continually talk about in the fight against inflation is this, as being the part that everything's trending down, they're kind of taking inflation out of the world, but this is going the other way, where it's actually, obviously, as we expect, when wages rise, that has a knock-on effect to the price of goods and services, and in particular services at the moment where wages are sort of getting stuck.
Yeah, that's true.
So I think, but having said that, the upside, as we talked about in the past, we had benign wages growth for a long period of time. So, it's an interesting debate, because I think wages growth, everyone deserves to have wages growth, and that's nice to see that trend for people at this point in time, and particularly at a point in time when they need it. And interestingly enough, though, that wages growth still doesn't equate or kind of offset the level of increase in cost of living.
No.
So it's
correct.
It's interesting around that very piece of inflation.
So subsequently people are then having to dip into their savings.
Correct.
As the difference.
Yeah.
At the same time, when you've got, as I said before, interest rates going up by 300%, that's pretty significant, right? And I know I talk about this every time, but I think it brings it home to people.
Yeah.
Average price of a house in Australia is about $800,000. Cost of the debt is going to be $600, $650. 18 months ago, you were paying 2%. So on $600,000, you were paying $12,000 a year in interest.
Yeah.
Now you're paying $6,000, so you're now paying $36,000 a year in interest. So that's there's $24,000 that's gone out of the economy.
Yep.
It's got to be funded by the homeowner.
Yep.
So
And that sort of speaks a little bit to, those GDP numbers we saw before, is that if those funds aren't available for discretionary spending, then essentially we see things, stop.
That's right.
Retail spending, as an example, is at really low levels today.
That's right. Okay. So another chart in here, which is I guess we wanted to talk through as well, is around how aggressive the tightening has been relative to other tightenings in the past, over the last 20, 30 years. So what we're looking at is this is in the US, this is the 22-23 tightening, so this cycle that we've currently seen, but in relative terms, looking at 94-95, which is this one here. 2015 to 2019 was much slower, so things have ratcheted it up very, very, very quickly, which I think they needed to. But you can see the same thing in Australia. So this is sort of where we've ended up from a RBA hiking perspective, versus when the bond market crash occurred, the previous one, that was 94-95, and it only got to about here. So it's been sharp.
It has, and I think particularly, and there's always a risk you can read into these charts in any way you want to interpret. But certainly some of those previous rises in history have resulted in slower economic conditions. And we were talking before about the lag effect of interest rate rises. We haven't seen what this next period of time follows, but I think we'll touch on it in a moment about what does an investor do with data of this kind.
Yep.
And that's sort of what matters most in the forum that we're talking about today. And I don't think there'll be any surprises when we sort of start picking this apart from a portfolio construction perspective, in that holding our nerve through different market cycles is so important, right?
Yep.
And this is another point in time where that is probably as relevant as ever.
Business and consumer sentiment. Look, the consumer, as we all know, the consumer confidence numbers are down just based on that information that we've given before around increasing interest rates and wage price theft. Can I call it that? And then that's also pretty similar, but not to the same extent in terms of businesses. So business conditions, this and that business survey, business conditions are okay. They've come off the point where they were. Business confidence is probably below par in terms of how businesses, both large and small and medium enterprise businesses, are feeling. But then capacity utilisation is at almost its highest level, which means that the businesses are doing as much as they can to continue to be able to provide product or service at a current prevailing level.
Yeah, and I think as well, we talk about business confidence, what's a measure of that, and we saw it on the previous slide, interest rates. Businesses by and large will look to expand as much as they can, and with the uncertainty of cost of capital to do that, it does weaken confidence. So I think there's some positive that comes out of even rates sitting on pause, even if they stay at a restricted level.
Yeah.
If businesses can calculate what their cost of capital will be,
yes,
I think it'll turn that around a little bit to making businesses more confident to kind of press forward.
That's right. Agreed. Okay, so let's move into return numbers now. So what we're looking at here is bond markets, and simply I've just run this for the last 6 months, both the global market and the Australian market. We're really just looking at zero over the last 6 months. We had a bit of rally there back in April, but then since then the markets have just flattened out a little bit, which I think is okay, because if we had a look at the previous 12 months, we're looking at some fairly hefty negative returns. What we're keen to work through though is, and as we've talked about in the past, the returns on bonds are dictated by the expectation of future yields. And so what we wanted to talk through here is, what does happen to bond returns, the capital value of bonds, if yields either rise by another 50 basis points or potentially fall by another 50 basis points. Do you want to talk through this?
Yeah, And there's two parts to return for any asset, obviously income and
Yep.
growth, and bonds no different to equities have that fluctuation in price. So, and I think it's good to contemplate this when we kind of hear about the news. Are we going to have more rate rises, or are we going to see rate cuts? And what does that mean from an investor's perspective? Yep. So, if we look at just the 3-year yield there, so on the left-hand side we see a yield of 3.75, which is the prevailing 3-year bond yield today.
The current yield.
The current yield.
Yep.
So if we saw a 50 basis point rise, so 2 interest rate rise of 0.25.
And that's the Reserve Bank increasing interest rates.
Reserve Bank increasing interest rates. What we would see is the net return to the investor on a 3-year bond decreasing to 2.7. So basically it means there's approximately a 1% or 1.05% decline in capital value. And it's interesting because on the flip side of that, if we see rates fall, the opposite there happens, and we see a 1.05% increase in the valuation of the bond. So I think what matters enormously here is that we're kind of getting closer to this, this neutral position on interest rates.
Yeah.
And all narrative at this point, unless there's a shock comes from left field, is talking about rates either staying or potentially one further rate rise. And or maybe two, worst case scenario, right? So when we look it up here, what it highlights, I think, is the downside is now significantly lower than what we've experienced and lived through over the last 12 to 18 months. But the upside on the other side of the coin there is quite high. And if we extrapolate those numbers out beyond 50 basis points to, double that or, further, which may be possible in 3-4 years' time, that we see, a better bond yield and better return, or lowering bond yield, but increasing capital value.
Yes.
So I think it's a great slide. I mean, there's a lot to unpack in that, and it's hard to sort of wrap your head around, but I think it does show and visualise the expected outcomes for bonds if we see rate rises or falls in the next 6-12 months.
Yeah, agreed. Bond investors, which form part of pretty well most portfolios, not all of the portfolio, but often a part of it from a diversification perspective. Bond investors have had a little bit of a rough ride whilst interest rates, yields have been rising. Yeah. And I guess part of our role, and a big part of our role, is to help investors and our clients understand and unpack why you have diversification in your portfolio, when is a good time to hold these investments, when is a good time to be patient, and we probably contend now is a good time to be patient, right?
Agreed, and I think your point there is valid, is that it's been a difficult time, and often when we capitulate as investors or have that sort of sense of I've just had enough of that asset class, it typically is psychologically the worst time to be making those changes. And it's easier just to say it flippantly, and it's not a flippant comment because it really does play to investor psyche. But I think this bodes well for for bond holders in the next 6-12 months and beyond.
Yeah, very good. It's a good slide. Okay, so over to equity markets now. From an equity market perspective, we've got the ASX 200 there, which is up around about 10%. That includes dividends. S&P 500, which is up 15%, and the Stocks Europe 50, which is up 16% over the last 12 months. So it's been this is, for context, this is interesting when we think about the first slide that we went through, Shane.
That's why I'm smiling in one sense is like, and again, I smile in a genuine way because we get asked all the time, and people, rightly so, don't understand why we have all this chaos in the world, but our equity markets have still been quite strong. And sometimes there aren't answers to those questions either. It's simply the weight of money and the sentiment of the world about what happens next is what people are feeling buoyant about over the last 12 months, and we're seeing it in these numbers here.
Yeah, which is great. It's a
good thing.
They're good numbers. They're great numbers. I think equity markets they're generally forward-looking, and well, even bond markets are too, right? But they're genuinely forward-looking. So they look forward 12 or 18 months as to what is the economic data going to be in 12 or 18 months. And probably equity markets over the last 12 months have priced in the fact that we're going to see inflation come down, GDP growth flatten out, and then start to take off once the economy is feeling a bit fresher, I suppose. So whether that is the case or not, a long-term time frame will tell us that. But the short term is a little bit harder.
I think sometimes too as well that we hear a lot of economic discussion from central banks, governments, and one thing I do like about the market and the market returns is that the market doesn't really lie, because it's the sum of all people and it's the sum of all people's thoughts.
Yeah.
So it's a good reflection that despite all the negativity that's been out there, the market has been feeling quite positive about the future. And we've lived through earnings season recently here in Australia, and mixed reports come out of different businesses, but market is still sitting there and feeling okay about the outlook.
Yeah, that's right. And then just over the last month, we haven't really seen much movement in equity markets at all. All right, so we generally always finish with this one. It's around patience, diversification, long-term investment strategies win the day, and I think we would always agree that is the best way to approach investing, is not to just buy one asset class, be that just Australian equities, or one asset class, be that property or be that global equities. It's important to get little bits of return from lots of different places. So, and then patience in the market.
And I think if I can add to that as well, is that it's all, like you said, to your point, they're all asset classes, bonds included as a asset class in their own right, as is cash. And I think today, what investors have that we haven't had in recent times, which is an important consideration, is a reasonable rate of return on term deposit and cash.
That's true. Yep.
So as a result of that, we're now in a great spot, I feel, as though, in regards to having the ability to have more liquidity in portfolios for those who need it, and getting rewarded for it. Whereas in recent years, we've seen some anomalies in share markets and property markets for that matter, because people have had to find return somewhere, and it's just fundamentals have got thrown out the window a little bit, and it's been weight of money that's gone into asset classes that have influenced returns. But today we actually have a better return profile for those more conservative assets that we haven't seen in recent years. And even bonds, we saw before the bond yield, we go back 18 months, so it's sitting close to zero.
That's right.
I think that's just a important point in that whole process there, because we can feel good about that. I think as investors, that we've got some stability in our portfolios that we can actually lean on if we have any more volatility in the future.
Completely agree. All right, I think we're going to finish it up there, but and we'll finish on our disclaimer. There's clearly only general information, Shane. We haven't taken into consideration anyone's personal circumstances at all. So typically that requires tailored advice specific to the client, which is our disclaimer up there. But okay, look, thank you. Thanks, everyone. Thanks for tuning in. Hopefully you got to the end. It's been lovely to do this again. And so we'll see you next month.
Bye for now. See you then.
Bye for now.